So down in the south, which is hurricane prone, one of the ways to evacuate is to check out the Waffle House. Now, if you've never been to a Waffle House in the south, it is delicious for breakfast or pretty much any time. It's open 24 hours a day, Joel. You can always go in and get some coffee and some eggs and some waffles.
The best time for a Waffle House is 2 a.m. because it is breakfast and a show.
But the weather forecasters at the Waffle House appear to have an inside knowledge of where these storms are going because everybody's paying attention to if the Waffle House is closed, that means get out of town. Or if it's open, then maybe it's not going to be so bad. So instead of listening to the National Weather Service or your local weather person, we're relying on the Waffle House to determine the fate of hurricanes now.
Alan, it's why I made a reaction when you did this is I actually have a LinkedIn post that I put together about the hashtag WH index, the Waffle House index that was coined by a FEMA director back in 2004. And what it was is he was down in Florida surveying, and I can't remember what hurricane that was, but surveying a hurricane damage, and the only place he could find that was open was Waffle House. So he separated into three things. It's green for Waffle House is all a go, yellow for Waffle House has a limited menu, and red for Waffle House is shut down. And if all the Waffle Houses look red around you, you better evacuate.
It's a good rule of thumb. And I know people in Western North Carolina, Eastern Tennessee, and now sort of Central Florida are really going to have a bad go of it. And yeah, serious stuff, everybody. Pay attention. Keep your heads down. Get out of the bad weather. Welcome to the Uptime Wind Energy Podcast. I'm your host, Alan Hall, and I'll be joined by my Uptime co-hosts after these news headlines. In a major development for European offshore wind, TotalEnergies has agreed to acquire a 50% stake in two large-scale offshore wind projects from RWE in Germany. The combined capacity of these projects is a staggering 4 gigawatts, located northwest of the German island of Borkum. Investment decisions are expected by 2027 and 2028, with full commissioning planned for 2031 and 32. The partnership not only strengthens TotalEnergies' presence in the German electricity market, but also significantly contributes to the country's efforts to decarbonize its energy sector. Across the Atlantic, Canada has passed groundbreaking legislation opening up its East Coast to offshore wind investments. Bill C-49 creates a framework for developing offshore wind energy in Nova Scotia and Newfoundland and Labrador. The bill amends the Accords Act, allowing federal and provincial governments to jointly manage offshore wind resources. As a result, regulatory bodies have been renamed to reflect their expanded role. The Canadian government sees this as a significant economic opportunity, potentially creating thousands of jobs and attracting billions in investment. In a bold move to support innovative technology, the Norwegian government has proposed a substantial subsidy of up to 35 billion Norwegian crowns, or approximately 3.29 billion US dollars, for the country's first commercial floating wind power tender. This support aims to accelerate the development of floating offshore wind technology, which is still considered immature and expensive. The subsidy is based on a reference project of around 500 megawatts in size, but the actual capacity realized will depend on various factors, including cost developments and project maturity. Moving to the UK, Leeds-based engineering services company Renew Holdings has made a strategic acquisition, purchasing Dutch firm Full Circle Group Holding, BV, for £50 million. Full Circle specializes in repair, maintenance, and monitoring services for onshore wind turbines in the UK and Europe. The acquisition allows Renew to enter the growing onshore wind services market, which has been bolstered by the new UK government's lifting of restrictions on onshore wind projects in England. In industry news, German wind turbine manufacturer Nordex reported a decrease in third-quarter orders compared to the same period last year. However, for the first 9 months of the year, the company secured orders of 5,000 megawatts of wind turbines, slightly higher than the previous year. The average sale price per megawatt of capacity remained stable at 900,000 euros, with a slight increase to 920,000 euros in the third quarter. Lastly, significant progress has been made on the 1.2 gigawatt Baltic Power offshore wind farm in Poland. The first of 4 directional drills for the onshore connection has been completed in the Lubiatowa area. This 1.4-kilometer tunnel will house power transmission cables connecting the offshore wind farm to its onshore substation. The project, developed by PKN Orlen and Canada's Northland Power, is on schedule. Construction of the onshore substation is over 40% complete, with full completion expected in the fourth quarter of 2025. Baltic Power will be one of the first European offshore wind projects to use Vestas' new 15-megawatt wind turbines and is scheduled to begin operations in late 2026. That's this week's top news stories. After the break, I'll be joined by my co-host, renewable energy expert and founder of Cardinal Consulting, Rosie Barnes, CEO and founder of InterStore, Phil Totaro, and the Chief Commercial Officer of WeatherGuard Lightning Tech, Joel Saxum.
As busy wind energy professionals, staying informed is crucial. And let's face it, difficult. That's why the Uptime Podcast recommends PES Wind magazine. PES Wind offers a diverse range of in-depth articles and expert insights that dive into the most pressing issues facing our energy future. Whether you're an industry veteran or new to wind, PES Wind has the high-quality content you need. Don't miss out. Visit peswind.com today.
Well, the biggest news in Denmark is that Equinor, Norway's energy provider, has purchased a 9.8% stake in Orsted, valued at approximately $2.5 billion US dollars. And this is causing a lot of shockwaves around the world because I think no one thought that Orsted would ever sell any part of it to Equinor. However, Joel, I do think this makes sense from a couple of levels, right? Financially at the moment.
Yeah, there's from a lot of levels, right? It's a win-win for both of their goals. So Equinor being, Equinor is Statoil. That's the Norwegian national oil company, as was Dong, which is Ørsted, as the Danish national oil company. So you see this transition, right? Dong has transitioned over to be this renewable energy giant. Equinor continued along its oil and gas path, but Equinor has goals by 2050 to have so much renewables in their investment portfolio. This is getting them further along the lines to making those goals a reality. Also, it puts money and some powerful backing into Ørsted. So win for Equinor on the getting towards the renewable goal side, win for Ørsted for getting some more capital behind them. And to be honest with you, if you have Equinor that's invests in part of your company and you're working in the offshore world, well, Equinor is a fantastic offshore player, whether it's oil and gas or not. They know how to do things, and they've invested heavily in offshore as well already, right? They're a part of Highwind and some other cool, innovative projects. So to me, I think that, they're not, in the press release, they did say that they're not shooting for a board seat. If I was Ørsted, I would almost ask them to be on the board. I mean, you're here. Why not come and be a part of the game?
I think that would create an international situation, and rightly so. But it does, Phil, beg the question, what's the move by Equinor? Is it just there to back Orsted in a sense that they're neighbors and they're all heading in the same direction? Because it does seem like Equinor is getting back into more oil and gas at the moment, while Orsted remains firmly committed to renewables. Is that just the play that both of them can win, that Equinor gets a little bit more of a renewable portfolio without them having to develop it, and Orsted gets the funding they need to go off and do that?
Yes, at its most simplistic level, and largely because, this was touted as a possibility for a while, I'll say, but nobody ever really believed it was going to happen until it did. But the reality is the reason that it happened was Orsted needs the stability of large minority shareholders like Equinor because of not just the cash that they bring to the table to help offset some of the uh, issues that Orsted's had, particularly with their offshore developments in the U.S. But it provides that risk diversification for Equinor, in terms of having access to a renewables portfolio without having to directly pour money into it. They're trusting Orsted's team to go and continue the offshore and onshore development process. But at the end of the day, I mean, this isn't like it's a huge capital infusion. It's basically, Equinor positioning themselves, if something were to happen and, a larger minority stake or even a majority stake became available, they might be in prime position to step in, should that occur in the future. Nobody hopes it does because, that would mean kind of a financial disaster for Orsted, but it's just at this point, it's just like any other, minority investor in any size corporation saying, all right, well, we're going to take a position, we're going to hold it. It's worth, putting a little bit of capital behind it, and just waiting out what the future brings, and then seeing how we, either increase or decrease the position from there.
I think it's interesting because coming at the same time that we've seen a bunch of oil majors back out of direct development, right? BP just announced they're going to sell their whole onshore fleet in the United States. We've seen Shell pull out of offshore wind. BP will also pull out of offshore wind and focus back with what's good returns for their stakeholders and shareholders. Whereas Equinor, like they've kind of dabbled in it and they're along the same lines where they haven't, they get to dip a toe, they get to be a part of the energy transition, but they don't have to be the upfront developer. I think it's a smart move by them.
Rosemary, how does this play in Denmark? You lived there for a while.
I think I've mentioned it before on the podcast. I feel like in Denmark, they are pretty competitive with Norway about energy companies. And in particular, I think that people are still very aware that, back when Denmark and Norway split into two separate countries and they drew the line that would divide, which were Denmark's waters and which were Norway's waters, they didn't realize at the time that they drew that line so that Norway got all of the oil, basically. So I think that there might be, and I haven't spoken to any of my Danish friends about this, but I feel like there might be some sort of feelings about Norway coming and, taking part of their big shiny national energy company. And I do think that it's a story to be really proud about as well. The Ørsted story or Dong story, I don't know of any other oil and gas company in the world that has actually managed to transition to a clean energy company. I don't think that there is one where they have legitimately got out of oil and gas and now are leading in renewables. So, I expect that Danes are proud of that, and I definitely think that they should be. So it's also a bit funny with Norway, they have a really, really great green, environmentally conscious reputation and appearance, leading the world in electric cars, 100% clean electricity grid, all of those things. But, just slightly beneath the surface is the fact that that's done based on money that they've gotten from fossil fuels, both within their country and expanding out. And, I got a little bit thingy about it when there was a time a little while ago when Norway was making a big deal about we're not going to exploit the Lofoten archipelago for their fossil fuel resources because it's too special. But at the same time, they were in an incredibly beautiful part of the Australian coast trying to develop that. So I felt like, like as a national kind of thing there where I felt immense hypocrisy from that stance. And there is a really weird tension in Norway between all the great things that they're doing for the world, which I definitely can't deny that they are. And the people do have an immense love of nature and spend a lot of time outdoors, and that's important to their national identity. But at the same time, the funding for all that does come from continuing with fossil fuel projects. So they also have quite a few renewables projects, more so than many other oil and gas companies that like to pretend that they also are moving into renewables. I think that Equinor is actually seriously intending to have offshore wind and floating offshore wind be a big part of their future strategy. So I don't want to get too cynical, but it's just, it's a really complex story, and it definitely doesn't just fit into, Norway is good or Equinor is good in terms of, climate. There's a tension, and it will be interesting to see. I can't imagine that they would be investing in Ørsted expecting to take it back to oil and gas, So I'm assuming that this does count as more indication that in the future where they want their direction to go is more towards the renewables area. So, tentatively think this is probably a good thing.
Phil, it does seem like Equinor's going to acquire about 10% total in Orsted. Why 10%? What is the magic number there? Why are they stopping at 10, or is there some threshold?
No, I think that's probably what shares they could buy either on the open market or what shares they might have been able to buy from Orsted themselves if Orsted had been doing some share buybacks and had some shares available to be able to offer privately to Equinor. I think the rationale is that they don't really want to go much beyond I think it's 9.8% if you want to be extremely precise with it. And the reason for that is, again, they want to have a minority shareholding. I believe they're now the number 2 minority shareholder in the in Orsted at this point. So, for them, it's fine. Again, they just have a little, it's kind of a dip their toe in the water jobby at this point where they're just going to see, how that goes and, take it from there. As I said before, they may end up increasing that in the future. They may pull out and start plowing their own money back into, their own renewables developments. Again, unless something drastic happens, I don't think they're going to be able to take a majority shareholding for reasons that Rosemary just went into. But at the end of the day, I mean, it's we'll see where they go from here. But for right now, it's just something that provides some stability.
We're not a stock program, so we're not following stock that close, or financial program. But the shares of Orsted are way down, like 70% from where they were in late 2020, if I believe. So does this make sense from just a financial standpoint that Orsted is only going to go up over the next couple of years, and your ROI from a 10% acquisition is just a cash play in a sense?
If you look at just what just happened, so they're down, Alan, you're right, 70%. It's like 61 or something like that from early 2021. But just, okay, so they put so their stock, their value right now is worth about 2.5 billion, Equinor's. So upon this, the stock went up, or Orsted stock went up 5.8% in that day. So that 5.8% is worth $145 million in a day to Equinor. So
come on, Phil, you're our insights. You're supposed to let us know this before it happens.
But you're $2.5 billion in it.
Yeah, but that's what I'm saying is as a percentage of their overall market cap, it's not really, that's why I'm struggling to be as excited about it as others, I guess. It's like, again, they're dipping their toe in the water.
Does it give them insights into what Orsted is going to do before the rest of us hear about it, because they're in the boardroom in a sense?
Well, of course, yeah.
Well, isn't that a huge advantage for them?
From a couple of perspectives. One, again, because they are such a large minority shareholder, and they've publicly stated in the Danish press that Equinor did, that is, that they're interested in helping to, again, without taking a board seat, which, again, we can debate a little if you want, why or why not do that, but at the end of the day, Equinor has said that they want to be able to, help and influence and guide Orsted's decision-making and strategy as much as they can, or as much as Orsted wants them to. So from that perspective, they're there. I think it was a bit deliberate the way they said that and what they said in the Danish press because, again, going back to what Rosemary's mentioned, it's a little bit touchy, between the two countries. Yeah, and at the end of the day, it's one of those things where, all right, so they're providing, like I said, they're providing some stability. It's at this point still a minority shareholding, and they're gonna kind of just wait and see.
All right, after the break, I want to talk about something it's influencing the price of turbines, particularly in 2026. This carbon border adjustment mechanism and what it means for wind in Europe. Dealing with damaged blades? Don't let slow repairs keep your turbines down. Blade platforms get you back up and running fast. Blade platforms' truck-mounted platforms reach up to 100 meters, allowing for a quick setup, improved safety, and efficient repairs. Book soon to secure your spot and experience a difference in blade access, speed, and efficiency. Visit bladeplatforms.com and get started today. Well, a study was commissioned by Wind Europe and prepared by the UK consultancy Penta and EY, and it was looking at the impact of the EU's carbon border adjustment mechanism on the European wind sector, right? So the carbon border adjustment mechanism, based on this analysis, could raise the price of an offshore wind turbine by almost €1 million. Now, there's some factors into that. It seems like about 25% of the turbine is imported and would be affected by this border adjustment mechanism. But first, let's just take a step back. Rosemary, what is a carbon border adjustment mechanism for those of us in the United States that don't have one of these things?
We've got to call it CBAM. CBAM makes it sound very exciting, right? So that's the first correction that I'll make.
Sounds like I'm getting taxed. That's what it sounds like.
So basically, countries that are taking action on climate change, like Europe has a price on carbon for, within the EU, they're concerned that what that means is that energy intensive products it won't be competitive to make them within the region anymore. And countries without a penalty on carbon emissions are going to be at a competitive advantage, and that without any mechanisms in place, you would just see, say something like cement or steel, instead of continuing to make that locally in Europe, where those companies have to pay for all of the emissions that generates. You would just see countries outside of the region who don't have to pay a carbon tax. They would be able to sell them in cheaper. And so those industries would suffer. So the way that they are getting around that is by having the carbon border adjustment mechanism to basically level the playing field between inside and outside of the region.
How does that practically happen, though? If I'm going to buy steel from someplace else outside Europe, what tax do I apply to that? And how do I know they're not building or making steel in a green way?
I mean, Alan, the thing with this is it's half of it is, Europe's doing what they have to do because they've already enacted this carbon pricing. But they're also, never at a loss for shooting themselves in the foot, are they? When it comes to trying to level the playing field. They always do it in absolutely the worst possible way. And this is yet another example of where they're trying to be fair to anybody that's, going to be leveraging a global supply chain. They're trying to be fair to their own domestic manufacturers within the EU. But at the end of the day, this is why we have global supply chains in the first place, is because if you can get the thing cheaper someplace else and import it, you want to be able to take advantage of that price arbitrage, because then the cost of the energy transition, the cost of capital, the cost of everything isn't higher. So putting a tax on things necessarily, compensates somebody who feels like they're losing, whether it's a government or domestic manufacturers, etc. But again, this is problematic because you're ignoring the fact that a lot of these things that are going to be subject to the CBAM are going to be things that we already import, which is why they've done this study and they're saying that upwards of 910,000 euro per turbine is what the price increase is going to be for not for nothing on a that's almost like 8 or 9 or 10% of the cost of a wind turbine. Certainly an onshore turbine in Europe right now, and an offshore turbine, maybe it's only 5%, but guess what? Who pays for that extra 5%? The rest of us as electricity ratepayers, because if the price goes up, they have to go get more capital. If they have to go get more capital, that increases lending rates and increases all these other things. And that means necessarily they have to have a higher power purchase offtake contract. If the PPA is higher, then the rates that we pay as electricity consumers have to be higher to pay for that extra 5% that's baked into the PPA. So the point is, you keep finding ways to raise prices, and it's just going to, ruin it for electricity consumers. It's not going to solve the fundamental free trade issue that we have.
But at the end of the day, Phil, exactly what you're saying to me, like at some point in time, you hit a ceiling where you're not going to be able to sign a PPA high enough to cover this stuff, and you're just going to stop the energy transition. Like, it's just not going to happen. It's just going to be like, it's too expensive because of all these rules, laws that we've enacted, and so we're not going to do it anymore.
I mean, Joel, this is the same argument that oil and gas companies are making right now, saying we're going to pull out of making investments in renewable energy projects because we're not seeing a return on capital. If you make them even more expensive, then they're going to keep plowing money into oil and gas, and it's going to end up reversing progress that's been made. I mean, you're saying it's going to stop the energy transition. I'm saying it's going to reverse it.
I just don't, while you're reading about this, I don't understand how anybody sits in a room and writes this legislation or this CBAM, writes this and looks at each other with a straight face and says it's a good idea. I don't understand it.
But here's the thing. Going back to what Rosemary's saying, I see why they enacted it. Because if you're going to adopt carbon pricing within the EU, if somebody's going to manufacture something outside the EU and bring it in, it's theoretically unfair to the people that have to pay the carbon price tax within the EU in the first place. So I get it from that perspective. However, what we didn't address was Rosemary's earlier question, which was, isn't there a way, if somebody can demonstrate that this was made in a carbon offset fashion, whether it's the steel, the concrete, whatever is being imported, whatever would be subject to the CBAM, if they could demonstrate that was done in a quote unquote green way or carbon offset compliant way, why can't they necessarily apply for an exclusion on those goods or get, certain companies' goods excluded from the CBAM if, regardless of what country it's coming from, just say, all right, well, we're going to make green steel or we're going to make, and just do it that way. That seems like it'd be a better mechanism. Am I wrong? I don't know.
I think that makes sense, Phil. But I guess what I'm looking at here is okay, to take it from a U.S. standpoint, I know that my friends in Europe are under the same pressures we've had in the last few years, is inflationary pressures and some other things that have just like the local household is struggling a little bit with finances because of what the global economy has been doing. But now you're putting more pressures onto that local household by having to basically, because what the local household, wind turbine operators or developers end up being that local household. They end up being the one that's the end user that's paying for this. The same way that if you were buying a car and all of a sudden the price of the car goes up because imported steel or whatnot with this CBAM thing. But what ends up happening is I know that there's a cost associated with energy transition, but the general public might not be able to afford it if you just keep jacking up the prices on everything.
Isn't it a real circular argument, though? If let's just, we can use the UK because they're not part of the EU, but let's just use them as an example. So if the UK decided they were going to put a tariff on parts that are going into a wind turbine, great. All right, so they do this thing, and it raises the PPA prices. But ultimately, the UK government is accepting those offtakes, right? So they're like taxing themselves, and yet they have this pool of money of which they've just taxed sitting in the treasury, which they don't call it a treasury, but then they would just subsidize the cost of electricity. generated. It's just like a pass-through in a weird sense, right?
That's maybe a specific situation to the UK because they have the contract for difference mechanism. In countries where you don't use a contract for difference, then it's maybe applied in a different way. But to your point though, yeah, it doesn't. I mean, how many times have we talked about this on the show, right? Like, but it's just governments don't they put policies in place that make it look like they're fighting for energy transition or fighting for the environment or doing whatever it is that they think they're doing, and it's probably mostly to get votes, but at the end of the day they don't create the market environment in which investors feel comfortable putting money in a way that's going to unlock the capital necessary to get the energy transition to happen. So it's like you can try to score all the political points you want by enacting whatever policy you want, and you can go have COP29 in Azerbaijan, and everybody's going to come out of it saying, all right, well, we're really going to do something this time, and nobody's going to do anything if you don't create the environment that makes it possible and necessary for investment to flourish and for investors to see return on that capital in the same way that they see returns in oil and gas or any other investment they could theoretically make.
Well, when we come back from the break, I want to talk about investment into a battery company in the United States, and I want to get Rosemary's opinion on how it's going.
Lightning is an act of God, but lightning damage is not. Actually, it's very predictable and very preventable. Strike Tape is a lightning protection system upgrade for wind turbines made by WeatherGuard. It dramatically improves the effectiveness of the factory LPS so you can stop worrying about lightning damage. Visit weatherguardwind.com to learn more, read a case study, and schedule a call today.
All right, Rosie, Form Energy has secured $400+ million in a series, not A, B, C, D, or E, it's now at F, financing. The funding round was led by T. Rowe Price, of course, and GE Vernova has joined in as a new investor. And if everybody remembers from our discussion a while ago about Form Energy, they're making the iron air long-term storage battery. And they're building a factory, I think it's down in West Virginia, if I remember right. Rosemary, they've raised a little over $1 billion total to build this factory to basically take Studebakers and grind them up and make batteries out of them. What is it taking $1 billion to do?
I think it's maybe this is a sign of things that are changing in VC world or just general funding of new technologies that needs to happen for all of these clean tech companies, because it's just a fundamentally different business model from what VCs are used to investing in, where they, usually you would prefer something that, one, would grow quite fast, and two, would have low CapEx requirements to get that growth. So, if you think about like investing in a company that's like got an app, like Facebook, where, it doesn't cost much to develop the app. It definitely doesn't cost very much different to have 1,000 users versus 10,000 users. And then you get, this network effect and everything just like grows very fast and there's this huge upside. Whereas hard tech, like actual physical hardware products, like most of what we need for the energy transition, it's not like that. It does cost more to make a factory that can put out, 1,000 units per year versus 10,000 units per year. And they do get cheaper with time, but it's not nearly this kind of like same explosive growth that we have been used to seeing within investments. And then the other thing is just the time frames. Like you can develop a smart piece of software in a year or two, and like gradually improve it. But for really big physical things, it's going to take you probably minimum 10 years from the smart science that was discovered through to having something commercial scale, and then probably another 10 years before it's scaled up far enough that it's actually making a difference in the market in terms of like actual volumes. So there's a really well-known problem for not just clean tech, but I'll limit to clean tech because that's the space that I play in. There's a really big problem, first of a kind projects are a certain type of funding challenge because it's not proven yet. It's quite experimental. And, that's well known that it's quite hard to get your funding for the first project, the pilot factory or, whatever. But what's proving to be an even bigger challenge than that, because there are quite a few companies that are investing in first of a kind, because there's quite a lot of upside to be taken from that risk. The bigger challenge is second, third, fourth, fifth, sixth of a kind. That sort of area where it's not like totally brand new anymore, and you're not getting in early enough that you're going to expect to 10 times your investment within a few years. But it is not yet proven enough that a bank is going to finance it. And so that's this new funding challenge that needs to be, we need to find out how that's going to be done for any cool energy technology that you can think of that has to actually be physically manufactured. They're all experiencing this same kind of issue. And so unless you've got a literal billionaire funding you with deep pockets, then you're going to need somehow to come up with at least probably hundreds of millions of dollars and, sometimes a lot of hundreds of millions of dollars to be able to build and prove sufficiently that subsequent projects can just be financed in the normal way by a bank or something. So I think that this, I will admit, I haven't actually looked at the terms of this fundraising, but I'm guessing that that's the kind of hole that it's trying to fill and what makes it feel a bit unusual. But I'm expecting we're going to see more of this because it's really needed. We don't lack for good technology ideas and that have been proven once or twice. But what we do lack is those same technologies to then move all the way through to implementation. Because, a good idea is not going to solve the climate challenge. It's going to be implementation that is going to solve it. And that means you got to scale up. Scaling up is where it's about.
I just have a question about how complicated this battery is and why they need a $1.2 billion. I think they've raised total. They're probably going to go get some more money to sort of roll the factory out. It's not supposed to be really in true production until 2028. Are batteries that complicated? Because I've seen Tesla build battery factories in a really short time for lithium.
Yes, but Tesla is really building on, very well-known manufacturing processes that have already been. They're not optimized. Like the optimization is continuing, but they really know how to, move things around as little as possible, waste as little material as possible. And the thing is, I work a lot with manufacturing, and in nearly everything that I do, it's not, is it hard to make this thing? And probably, if we think about anything that, the US is trying to make batteries locally, Australia is trying to manufacture solar panels locally, maybe some wind turbines as well. It's not that we can't make those things. Of course, we can make those things. What's hard is making them cheaply. And so if you, let's consider like a wind turbine tower as an example, because it's something that I've been studying recently. You take a plate of steel, you roll it into a cylinder, you weld a bunch together. Like any country can do that, right? But what is challenging is getting them cheap enough that you can at least come with somewhere within the same ballpark as what they're coming out of China for. And so that means serial production. That means that you have dedicated equipment and that everything is, arranged so that you're you're handling things as little as possible. You have machines that are doing double, triple, quadruple duty so that, everything happens exactly right. And it just, they just roll off one after the other, like probably, one every day in terms of like a wind turbine factory. That's how their kind of like minimal economic model is, that one comes off the end of the production line every single 24 hours like clockwork. And the more that you can do, the more savings you get. If you can't manufacture like that, it's going to be just much, much, much more expensive, right? You could have one person, one welder go around and, do all these things by hand, but that's very expensive compared to making the big investment in automated equipment, like, positioning equipment and robot welders and all that sort of stuff is where you save the money. Not at first. At first, you have to spend, $50, $100 million setting up your factory just to do stuff that, any guy or girl with a welding certification could go and do that by hand. But, that's what you have to do to be economic in the long run. And with long duration energy storage, it's just crucially about the costs. If you can't, lithium-ion batteries are getting just cheaper and cheaper and cheaper. And if your long-duration energy storage technology can't be much, much, much cheaper than lithium-ion batteries, then there's no place for it. So I think that they're trying to demonstrate that they can get to that low-cost price, and they've done their demonstrations. They're beyond the point where they can say, trust us, this is going to be 1/10 the price once we do it at scale. At some point, you need to do it at scale to show that that's what it is. And once you've done that, then a bank will back a project that uses that technology.
Were they anticipating that lithium would be their competitor? Because I thought when they first announced, this is a couple years ago, the iron air battery didn't have much competition for longer duration storage. That's why they were kind of standalone for a while in that competitive landscape.
Yeah, sure, it does. They're 100 hours. Pumped hydro would be the other thing that they would be, competing with, or some kinds of thermal storage as well. But I think that this is something that I've been saying about long duration energy storage right from the start. Like, everybody had the goalposts wrong. They're looking at where, 4 years ago, lithium-ion batteries were 1 hour, 2 hours. And so people were developing technologies like, we're going to be cheaper than lithium-ion batteries at 4 hours or 8 hours, but failing to look at the cost reduction curve for lithium-ion batteries. And, it's very easy to predict that by the time your technology at 4 hours or 8 hours, by the time that's mature, lithium-ion will have blown that duration out of the water as well, and you've got no space to play in. So Form with iron air, 100-hour battery duration, that's a lot further. Do we need 100 hours? But in any case, they have to be very, very cheap. Otherwise, there's no point.
The difference, though, here with Form Energy is they're actually saying that now how it's set up now, it actually complements lithium batteries. So what they're saying is when you put a long duration storage unit in, you do part of ours and part with lithium ion batteries, because the lithium ion batteries, I think, can charge faster and discharge faster than their technology. So it's like you have, Alan, it's like you and I were talking about turbochargers the other day, a small turbo that spools up and down quickly, and then a large one it may have more power in it, but it takes longer to spool up and get going. So it's kind of the same thing where they complement each other as a battery storage unit. So they're not, they're, in some respects, yes, they're competitors, but at another scale, what we need on the grid, we need both of those technologies.
As long as Form does get much, 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 much cheaper. If it is not much, 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 much cheaper, then it will never play that role. That's the thing. Like, all of the long duration storage technologies, there's nothing to say that you can't just put in 100 lithium ion batteries instead of one, Form one with a equivalent capacity. It's just that, we expect the Form will be vastly cheaper because it's just, it's made from very cheap materials. But that's the assumption that we need to now prove. And I will say most new long-duration energy storage technologies have not been able to reduce costs in the way that they assumed and promised that they would be able to, based on, back of the envelope and lab scale assessments. It just, the costs haven't come out the way that they needed to. And lithium-ion batteries just have. We should have been able to see, it's very predictable with learning rates. Once a technology gets started, you can see how much costs are reducing with every doubling of production, and lithium-ion batteries have just been doing that the way that you would expect. But it's just so hard to actually believe in those massive cost reductions. Lithium-ion batteries are getting so cheap that we really need to get to the point now with alternative long-duration energy storage technologies. They need to stop telling us their calculations for how they're going to be cheap and start showing us that they're cheap.
I'm not sure I would pick a market where I'm competing with Elon.
But one last thing to add on this too is the reason that Form Energy is able to raise as much capital as they have, and it is admittedly highly unusual to get to a Series F, capital raise. But the reality of it is that there are so many energy traders, energy arbitrage companies out there that want both the short duration, whether it's lithium ion or supercapacitor based or some other short duration technology that usually provides more of a grid smoothing capability. The reason that everybody's getting excited about iron air batteries by Form and by others is that in addition to being made from cheap materials, it's enabling a use case that energy traders want, which is long duration storage means they can, open up more opportunities for energy arbitrage where, they can sell power at a price optimal time back to the grid and bank power from wind or solar or whatever so that they have it in this long duration storage. It's basically an extra tool or an extra knob to turn when you're talking about grid balancing and energy trading. So that's why so many people are excited about it. That's why so many people are willing to put money behind it, is because it is going to potentially unlock, again, with those cost reductions, it's going to potentially unlock new use cases and business cases for the industry.
And they have orders. There's a dozen projects probably announced for these batteries. So, I mean, they might not all happen, but I think that the majority will. So that's obviously, an important piece as well.
Yeah, it looks like they've got orders from the California Energy Commission, XL Energy, multiple projects for XL Energy going on, Georgia Power. You see some other states up and down, Dominion Energy and up and down the East Coast. So yeah, they definitely have got some stuff moving.
If you haven't picked up the latest PES Wind, I'm holding it in my hands. If you're watching me on YouTube, it's heavy, Joel. This edition is thick. And I was scanning through it and noticing a pretty good article from the Odense port in Denmark and how massive that facility is. It's incredible, and how they've really transitioned from basically being a steel port to being a renewable energy wind port.
Yeah, if you are a part of anything in offshore wind, you've been touched by the port of Odense, or you've been connected to it at some point in time. Even some onshore wind projects. So it is Denmark's largest port, 8.5 million square meters. And for those of us who don't speak in square meters, that's about 1,800 acres, which is massive. Like, that's just a huge facility. And they have a lot more available there too. 2 million more meters available, and they're going to be growing by another million square meters. So another 250 acres that they're going to be growing by. And what they're doing at the port is they're continuing to innovate and basically make a port a part of the whole supply chain, which is really cool. So they want to be an all-component offshore port. So they want to have all the components, as many as they can actually manufacture there on site or nearby, they want to do right there. Then they want to do the sub-assemblies right there on site. So you have less handling materials, less risk involved, less logistics cost. And by doing all this, they think that they can actually reduce the cost of a turbine by 2 to 3%, which, I mean, to the armchair engineer, it makes sense, right? Do it all in one spot. Don't have to handle it, pick it, move it, anything like that. Things cost less. So they have a massive amount of acreage. They got big plans for being an offshore wind port. But the other side of this thing in the Port of Odense is they're an innovation hub. So there's test facilities down there. They do a lot of robotics. Maersk was down there for a long time doing large scale robotics for ships. So they've continued that legacy. So a lot of big things going down on there. And being that it's robotics and a innovation type hub of a facility, the engineers and researchers can be right on site developing things with new products right as they get loaded up quayside and off to fix the energy transition or to lead the energy transition. So the Port of Odense, pretty cool article in the PS Wind magazine this week.
Yeah, so if you haven't downloaded your copy, go to peswind.com. It's free. and you can check out all the cool articles.
This week's wind farm of the week is the Cardinal Point Wind Farm from Capital Power. It's up in Illinois, in operation since 2020. There is 60 GE 2.5 megawatt machines, 89 meter towers, 62.2 meter blades for a total height of 496 feet. Again, speaking from the U.S. side. And the interesting thing about 496 feet is it's right under 500, which is when you start to get into the Federal Aviation Administration's airspace. So that's why a lot of these are that high. But construction costs of this thing, if you're wondering what 60 wind turbine site looks like, it's about $240 million. Interesting in this project as well, Capital Power with Cardinal Point Wind, they did an interesting financial mechanism here. 12-year fixed price contract with an investment grade U.S. financial institution. So that means basically instead of getting the revenues, living on the revenues of the wind farm, they have a fixed price contract with a bank that pays them as much as the contract is, but then the losses and gains from that is a risk that the bank took on. So kind of an interesting financial mechanism there. The other thing that Capital Power does, and I really like this is why I came across this wind farm for the Wind Farm of the Week, is they put out community newsletters from the site supervisor of every one of their wind farms. So quarterly, the site supervisor and, of course, the marketing communications team, they get together and they write a newsletter to the local community, and they send it out around that area, and it kind of supports things of the different charities that they've been working with and whatnot. So pretty cool thing that Capital Power does for transparency within their wind farms. So the Cardinal Point Wind Farm at Capital Power, you are the Wind Farm of the Week.
That's going to do it for this week's Uptime Wind Energy Podcast. Thanks for listening, and please give us a 5-star rating on your podcast platform and subscribe in the show notes below to Uptime Tech News, our weekly newsletter. And check out Rosemary's YouTube channel, Engineering with Rosie. And we'll see you here next week on the Uptime Wind Energy Podcast.